Hey everyone, I got a question in the chat room. Actually, a couple of more than two people asked about DRI. It's a restaurant, Darden Restaurants. They own a whole bunch of restaurants. So um, down 5% almost on a reddish down day, flattish red day in the market. So down all by itself. And the last comment in the chat room was it's down because somebody downgraded it, Evercore or whatever. Who cares? Why don't we do our own homework and let's decide if it's a good time to catch the falling knife or not. So this is the RI, a daily chart, about 1 year worth of data. First of all, it's down 5%, but it looks, a year ago it was in the toilet. Somewhere in the middle lies the truth. And that's the message. This was wrong. This was wrong. Somewhere in the middle is more correct than the extremes. This up here, whatever above 148, has been a roof for a long time. 1, 2, 3, 4, 5, 6 months, going on 6 months. Now this drop puts it below that orange line. That orange line I don't draw. It's the point where it traded the most. This consolidation zone was busy, very busy. So if you fall below it, now going back above it is going to be a problem. Consider it like a current or whatever going over your head. To bust through it, you're going to have to do extra work. So is it a sell because this person said it's downgraded it? I bet you the downgrade still has a price target higher than where it is now by a lot. I don't know. I'm guessing. You can go do your homework. And that just tells you how ridiculous these things are when they downgrade, upgrade. It's so confusing. So let's do our own homework. Let's look at it from a fundamental perspective. Remember, it's a restaurant. 2020 was a throwaway year for most restaurants. However, CMG is the crazy, fast food. Anything that's takeout didn't get hurt. In fact, got more profitable. I know from a friend of mine who owns a lot of restaurants. So total revenue, 8.5, just under 8, 7. So things were already going the wrong way in 2019. So it's not a COVID story, that 7.2 dip. Okay, 7% to the year before it. That's nothing compared to a COVID impact. And then now running 12 months is still 7.2. Let me see, quarterly, did that improve a little bit? Yeah, maybe. Quarter 4 is stronger than the one before. It's stronger. Maybe it's seasonality. All in all, there's not a great story to tell, but there's not a mass panic out of it. Statistically speaking, it is 2.6 price to sales, 30 PE. I don't think that's cheap. Let me go to, I don't know, I'm going to go to McDonald's. I know it's not comparable, but it is a big beast. So 8 times sales, 25. So those two are, DRI is not expensive compared to McDonald's. We'll go to the most expensive restaurant I know. However, it grows faster than anything else. 8 times PE, 8 times price to sales, cheaper than. So I prefer this one over McDonald's. DRI is not expensive from that perspective. Maybe if you pull it up against some other restaurants, maybe it looks expensive, but I don't agree with selling the stock because somebody said so. So that leaves me to look at the chart for guidance. It lost a place where it shouldn't have, and now, like I said, it has resistance above. So if I were to trade it, I would sell put spreads, or if I was looking to buy shares, I would sell puts into the sphere. It has a potential bounce level, proven, not my theory. That's what happened late July, mid to late July. It bounced off of 134 plus or minus. So I would expect that there would be buyers there again. Do I have lines? I do. Oh, check it out. Okay, support zone failed. This was the line I had for it. Look where it went. Directly where I had it. And now it becomes an opportunity. I literally said that before. I don't remember drawing these. Buy the dip for, oh, I did. I do remember. Never mind. This one is I added recently. These two I had from before. So buy the dip for swing up opportunity. It's a zone. It's not a hard line in the stand. And the buy the dip method differs from person to person. I just told you what I like. I like to sell into fear. Fear is sell off. So selling puts or put spreads would be the way to do it. And this will be a catching the falling knife while leaving room for error. So how do I do that? If I go to DRI, now this is starting to sound familiar. Did I do this already? So first of all, the options are not very liquid. It wouldn't be the stock I would choose, but it is a viable trade. So if I were to buy the shares outright, I'd have to spend the money for the price of the shares. So 100 times $138. That's a lot of money. I can do it by selling puts below and commit to buying it at a lower price. All right, let me see here. October, so late September they report earnings. So if I wanted to own the shares, say around 130, let me see if we can get some. Yes, so I can sell October 120 put and collect $250. All I need to do is just buy the shares at 120 if somebody calls on me. Now this would include the earnings report, so there's that cloud from that. If I didn't want the risk from the earnings report, I can do it for September and sell and only collect 100 or sell the 125. Let me show you where that would be. Right here. So the worst case scenario for me selling the September put is to collect money to buy the shares here after it just fell 5%, after another 12% drop. And then, do I lose money there? No. On paper, the put itself that I sold will lose money, will show me losses, paper losses. And then if they assign me shares, those paper losses go away, and I would buy the shares at 120. My break-even point would be lower because I collected money now to be long. So my break-even price would be somewhere around here. I'm rounding. So not a bad situation to be in. And all I had to do is say now, hey, I'll buy your shares down here if you want me to for the next 30 days. So that's the September case. For the October case, I can go lower or collect more to stay there, because there's more time on the clock, so that person that's buying the put from me is collecting insurance for a longer period of time. Like here, if I sold this put and money goes into my account, and now I'm long, quote unquote, long the stock because I'm bullish. I want to buy it. And if it falls to me, good news. I bought it at 115 and I break even at 113 and change. Versus the person that's buying it from me, they're buying insurance. Hey, they own shares and want out of it. So it's a win-win situation. So that would be selling a put. As far as panicking out of the stock because somebody downgraded it, it's ridiculous. I don't know that somebody. Are they smart? Are they not smart? What's their history like? What's their relationship like? Have they told their clients already? Are they short the stock? Plenty of reasons why they would say something that would help their own books. Are they setting us up for a rally? Like, they downgraded it and then turn around and buy the stock to make money for themselves? I don't know. So why don't I make my own opinion? We have tools. We don't need them. So let's use our tools. I'm not a Wall Street guy, but I just shared with you logic. Okay, this was a big problem area into February. They broke out from it, tested it for footing 1, 2, 3, 4, 5 times, and this is not even close to coming to test it. I would say there are buyers lurking here. Can it fall apart? Sure. Let's say the government goes out and shuts down the world. I doubt they would do that. Also, is there an exposure to China? I don't know what's going on in China. So you have to do homework on that perspective. But given what I know now, I wouldn't panic out. It's falling into support. I wouldn't short it because they said it shouldn't be this high. That's for sure. Can I buy it? I'm not rushing to buy stocks, and I would have more compelling cases to trade than this one, but it is tradable. Okay, so hopefully that just answers the question with a good video that touches up on the basics of investing. First of all, make your own opinions. We have all the tools. I'm not recommending anything here because it is tradable this way and that way, and it depends on personal preference. If I have restaurants already, I certainly wouldn't add another restaurant. If I have hotel stocks, I certainly wouldn't add a restaurant stock, because if they shut down, everything crowd related is going to get hurt badly. So I make sure I have balance. If I have a lot of longs already and hurting on some of them, I shouldn't add more longs. I should balance my books. All these come into the decision. But the one thing I don't do is listen to some dude or dudette out there that decided that they want to write up an article against a certain stock. And by the way, I'm not a fan of this company. I don't look at it usually. I'm just answering the question. This Nick signing out.